Fed continues to raise rates and just is bluffing, gold wins either way, because if the Fed doesn't support the U.S. Treasury market, everything breaks, but the dollar. If the market breaks, it'll be a disaster. That will be depression. That will be a recession. But gold will still rise then. The Fed pivots to super mega QE, which I do think they will. Don't ask me what day, month, or quarter, but they will. They already have indirectly. That's good for gold too. Gold wins either way because the Fed is cornered. They can't win. They're going to sacrifice their currency to save the system, especially in an election year, but especially when you're looking down the barrel of 34 trillion, 35 trillion in public debt. Then you throw in unfunded liabilities, military budgets, fiscal dominance arguments. Again, it's not trying to be sensational. It's really, sadly, pretty obvious right now. I'm glad I'm in gold, but I saw this coming. We've seen this coming, but it's actually happening now at a faster pace.
Gold reached a historic peak at $2,135.39 per ounce in December 2023, propelled by a weakening US dollar and expectations of Federal Reserve interest rate cuts. In 2024, JP Morgan Research predicts that gold prices will hit a high of $2,300 per ounce, with the key drivers being Fed interest rate cuts and declining US real yields. This estimation is based on the assumption of a Fed cutting cycle delivering 125 basis points of cuts over the second half of 2024. Matthew Piepenburg, a partner at Greyerz AG, asserts that gold is expected to rise in either scenario, if the Fed fails to support the Treasury market, potentially leading to an economic disaster, or if they implement a substantial quantitative easing program. In midday US trading on a Thursday, gold prices are higher, driven partially by safe haven demand amid increased risk aversion due to heightened military actions in the Middle East. The February gold price was last reported at $2,016.10. Matthew acknowledges the challenge of predicting the precise timing of gold price movements, given gold's inherent volatility and non-linear trajectory. While some in the industry mention a target of at least $2,500, Matthew considers this a conservative estimate, emphasizing the complex interplay of factors influencing the gold market. As per Matthew's analysis, Federal Reserve Chairman Powell is signaling a pause and a potential shift to lower interest rates by 2024, with an anticipated significant QE program to support the US market following this move. According to updated quarterly economic projections, most Federal Open Market Committee officials anticipate rates falling to 4.6% by the end of 2024, suggesting the possibility of at least 3 quarter-point rate cuts in the coming year. We will present clips from Matthew Piepenburg's interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
Essential. The bond market is the thing. We've tried to save it backdoor QE through the TGA program, through different issuance on the short end and the long end, the TBFT program to save the banks. We've been doing backdoor QE. Now Powell's announcing a pause, then a pivot towards lower rates projected in 2024, which I think he'll do. And then eventually we'll see mega QE to support the US Treasury market, which is an unloved asset globally. So they will have to support the Treasury market. To do that, by simple math, they're going to have to resort to synthetic liquidity, i.e. QE direct, to support the yields and to support the bond market at the expense of the currency. That is not gold bug grandstanding. That is history 101. And so that just means more QE, more liquidity, greater debasement of the dollar, higher inflation down the road, inevitable. We haven't beaten inflation. That's another conversation piece, but it's the debasement of the dollar. And so gold's only direction is up and to the right. And again, when you're talking $5,000, $6,000 gold, it's not to be cocky. That just means the cost of bread, the cost of a car, the cost of everything else is going to go up too, including the cost of stocks. It's going to be very bullish for the stock market too, when Powell officially goes from a promised projection of rate cuts to an actual rate cut and then goes to super QE, which I think he'll do. And like Luke Gromen, I think it's inevitable. If they don't, if the Fed continues to raise rates and just is bluffing, gold wins either way, because if the Fed doesn't support the US Treasury market, everything breaks. Everything breaks but the dollar. The market breaks, it'll be a disaster. That will be depression. That will be a recession. But gold will still rise then. If the Fed pivots to super mega QE, which I do think they will, don't ask me what day, month, or quarter, but they will. They already have indirectly. That's good for gold too. Gold wins either way because the Fed is cornered. They can't win. They're going to sacrifice their currency to save the system, especially in an election year, but especially when you're looking down the barrel of 34 trillion, 35 trillion in public debt. Then you throw in unfunded liabilities, military budgets, fiscal dominance arguments. Again, it's not trying to be sensational. It's really, sadly, pretty obvious right now. I'm glad I'm in gold, but I saw this coming. We've seen this coming, but it's actually happening now at a faster pace. And even if you have a small shift in demand for oil outside of the dollar and in some type of arbitrage gold play, the gold price will go up significantly. We're talking this year, we're thinking for a number of reasons, many in our industry are targeting at least 2,500, but that to me is conservative. Again, don't ask me to time it. Gold never moves in a straight line. The direction, though, between the BRICS, between the central banks, between the petrodollar, not to mention just the U.S.'s massive debt spending. It's an election year. They're going to deficit spend. We went from 33 to 34 trillion quickly. We'll go to 35 and 36 trillion just as quickly. So we're spending more than we earn. The combination of our monetary balance sheet, which is a banana republic, but for the fact that world reserve currency, the combination of that debt reality in the U.S., the election year spending that's coming, the central bank purchasing of gold over U.S. treasuries, the weaknesses I see in the petrodollar, the momentum I see there, the weaponized U.S. dollar, all of these things point inevitably towards higher gold prices.
In December 2023, the Consumer Price Index reported a 3.4% increase in inflation compared to the same period in 2022. While overall inflation is downward, core inflation has remained relatively stable, experiencing a slight decrease since December 2022. According to Matthew, inflation hasn't completely subsided, despite the decline from its peak at 9% to approximately 2.7%. He attributes this reduction to rate hikes that led to a demand pull recession. However, Matthew argues that this should not be interpreted as the conclusive end of the inflationary trend. Goldman Sachs economists forecast 5 interest rate cuts by the central bank in 2024. Their projection suggests that Federal Reserve policymakers aim to achieve a soft landing characterized by a gradual slowdown in economic growth. Matthew contends that the Federal Reserve, under the leadership of Chairman Powell, is signaling a potential shift to lower interest rates by 2024, even before reaching the targeted 2% inflation rate. Let's get back to the interview.
No doubt, no denying that inflation has come way down from its 9% level to its 2.7% level. It kind of vacillates. There's no doubt that when you raise rates and force a recession on the middle class, or a demand pull recession by crippling them with higher interest rates, that you're going to have disinflationary forces. There's also no doubt that this is not the end of the inflation discussion. So between dishonest reporting and cyclical nature of inflation and fiscal dominance, I don't think this inflation era is even close to an end. As I always say, you play where the hockey puck is going, as Wayne Gretzky said, not where it sits, or in my case, the polo ball. There's backswings in polo. The game changes in a tenth of a second. You're going 35 miles an hour down the field, a backswing comes and you're turning your horse. It's the same with inflation. It's going to turn in again, not because I'm a gold bug, but because I'm a student of math and history. And where I look at it is, look, this argument about, first of all, why is Powell already throwing in the towel, so to speak, by announcing a pivot or a projected rate cut in 2024 when we haven't even hit target 2% inflation? That was his big obsession for the last couple of years. Got to get target 2% inflation. So why are we already announcing a rate cut in 2024? Because what Powell knows and won't say, and this is I think Luke Groen and others know it very well, you got to start with the premise that, yes, the Fed's mandate is employment and inflation, but its real mandate is Wall Street and the bond market. And the Fed cannot allow the bond market to tank much further. By raising rates to quote unquote fight inflation, there was too much stress on the bond market. We saw that in Q3 and Q4 of 2022. We saw that in Q1 of 2023. We saw it with the gilt crisis. We saw it with the regional banking crisis. We saw it with the bond prices tanking. Those are not banking crises. Those are bond crises. So Powell, with his official story of raising rates to fight inflation, never even got to target 2%. Now he's already announcing a pivot to lower rates. He will eventually announce a pivot towards more QE, in my opinion. But what's really happening is we have seen, and as the St. Louis Fed themselves came out with their fiscal dominance report in June of last year, that when you get positive real rates of at least 2%, our system, our debt-broken system, cannot stomach 2% positive rates. We need inflation to be higher than our yields. We need inflation to get ourselves out of debt. Our bond market can't take higher and higher rates. We've seen that over and over. November of last year, supposedly all this demand for bonds. No, it wasn't. It was 150 billion from the TGA account, and it was issuing more out of the short end of the curve. It was backdoor QE. Yellen and Powell have been a yin and a yang. Yellen really creating liquidity while Powell is being austerity with QT. We've been having versions of backdoor QE. Now we're going to have outright rate cuts and eventual QE. Don't ask me what day in 2024, 2025. We'll definitely see rate cuts, in my opinion, in 2022. I don't think Powell's bluffing this time. The Treasury market, the sovereign bond market can't handle higher rates. That's why he had to throw in the towel earlier than target 2% inflation, which isn't even really 2%. It's much higher than that. But still, there's also no doubt that raising rates throughout 2023 did create disinflationary forces. But as we issue more and more IOUs, whether it's in our war or proxy wars in the Ukraine or a hotter war in the Middle East, or whether it's to cover more and more fiscal spending to get us through an election year, we're going to have to issue more IOUs. The rest of the world isn't buying them at the same pace, so we're going to have to create money out of nowhere to pay for them. That will be inflationary. We will save the bond market. We'll probably save the stock market this year with massive doses of liquidity when needed, but we'll always be at the expense of our currency. Again, gold wins because the currency gets debased. They will debase the currency to save the bond market. And again, gold isn't as sexy, nor is it as volatile, and in some cases as euphoric as Bitcoin and others. I don't mock them, but it certainly protects your purchasing power better. For people of wealth, they've learned, and I've learned on Wall Street when I won the lottery ticket on a .com stock, it's okay to be wealthy, but the secret to wealth is not losing it. And the secret, I've seen it in family offices, generational wealth. The big joke is the best way to have a small fortune is to inherit a large fortune, because you don't know how to protect the wealth. You don't have to protect it. You're always speculating, which is an important role in our mindset. But you have to preserve. You have to preserve and speculate. Gold is just simply hands down the best preservation asset.
By the second quarter of 2024, JP Morgan economists forecast US growth will slow to 0.5% quarter on quarter. This should prompt the Fed to cut rates in June, ultimately delivering 125 BP of cuts in the latter half of the year to avoid a recession. How does this situation affect the price of gold? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel and turn on post notifications for more videos like this. Thanks for watching.